Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Illan. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Hi everybody, welcome back. This is Ivan Illan, the founder and chief investment officer for Aligned Wealth Advisors Investment Management, also known as AWAIM. So if you've been paying any attention, you probably noticed that the U.S. government debt has been downgraded by Fitch, one of the very large rating agencies based in the United States. Other rating agencies include the Standard & Poor's, Moody's, AM Best. So there's a few different rating agencies. Fitch is just one of them, but by all accounts, an important one. And so they have downgraded the U.S. government debt, U.S. Treasuries. So, and it went from AAA, which is the highest rating you can have, down a notch to AA+. So the last time we had a downgrade was around the great financial crisis. Things were pretty dire back then. But relatively speaking, the amount of debt that the U.S. government had back then compared to now, just call it half, half as much debt. So there's been a tremendous accumulation of debt over the past 15 years since the great financial crisis. And obviously things like the pandemic created extreme inflection points to the upside where there was just tremendous amount of new money creation in the economy, something that we also term as helicopter money, that the government basically just threw a bunch of money at the problem, and that landed in a bunch of checking accounts of all the citizens of the United States. And unemployment benefits had subsidies, and businesses were getting subsidized, and so there was a lot of money to go around. And now we're sitting at over a $31 trillion public debt. We certainly have the highest amount of debt of any nation in the world. Certainly on a per capita basis, we are nearly double, maybe 2.5 times that of the European Union on a per capita basis of debt. So this is certainly something that's quite concerning. And in this outlook, part of the downgrade is they provide an outlook. It details that they see fiscal deterioration over the next 3 years. So the point of that is they already, the government's already been receiving less money in tax receipts. And so if you're spending more money, you're issuing more debt, and you're receiving less income, it's presumably going to make it a little bit more difficult to actually pay down your debt, or even maybe, God forbid, even make payments like principal repayments. So the attitude has been for so many years that, the U.S. government can just issue debt, no problem. There's buyers always for U.S. government debt. And maybe that sentiment maybe is changing a little bit. Maybe the amount of appetite for U.S. government debt has waned a little bit globally. Japan has their own issues. Japan is the largest foreign holder of U.S. government debt, followed by China. And it's not exactly like China and the U.S. are best buds right now. So there's some, tension, maybe to put it mildly. And so it's something certainly to pay attention to be aware of, that this is happening in the backdrop. And since Fitch specifically cited fiscal deterioration over the next few years, think of it this way. Most of the money in the accumulation of U.S. government debt has been because of fiscal stimulus, has been putting, the Congress getting together and deciding to distribute money really hand over fist into the economy. And spending limits obviously have been increased, debt limits have been increased, and there is a barrage of new Treasury issuance that's still underway between now and essentially September, which is the end of the fiscal year for the U.S. government. So this certainly has been something that we at our firm have been looking at and talking about and publishing research on for some time, and so on some front it is good to see that a rating agency is actually paying attention to the financials and saying, hey, maybe maybe you should pump the brakes a little bit on issuing so much debt. And maybe wait till you start collecting more tax receipts and figure out how you're going to start collecting more money from your electorate before issuing more debt. So there's definitely a pause for thought, and there's certainly warranted concern for this announcement and this downgrade. And it will be interesting to see if other rating agencies follow suit. And of course, this is also ahead of an election year, which occurs next year, and we're already very much in the election cycle. Really, in earnest, begins this summer, and it starts to really gear up in the fall. And so with this as a backdrop, it may start to usher in some more cost-cutting behaviors from CFOs at corporations, and that could lead to higher payroll reductions, so increasing unemployment as we head into the end of the year, which of course is still very much part of the Federal Reserve's projection. Higher unemployment is in fact necessary to tamp down inflation. And even at lower rates of inflation that we have started to see, we're still sitting on about a 20% price level increase over the past 3 years. So it's quite significant, this mountain of price level increase that we've already climbed. So even if we are decreasing inflation by a little bit, and now it's only 4% year over year, to get down to 2% year over year, we're still increasing at a rate of 2% on top of already, this 20% increase over the past 3 years. So there's already a tremendous amount of inflation that is impacting the economy, and so one of the positive scenarios, which actually would have some pain economically associated with it, would be a disinflationary environment where actually price levels decrease and we actually get negative inflation, which is disinflation. So that mountain that we've already climbed of roughly 20% increases in prices, we'd actually, get some of that back, maybe go closer to, 15%. But that certainly would be accompanied by a lot of discomfort in the economy as capital markets adjust to rapidly declining prices. So those are some thoughts about the recent downgrade. And of course, if you have any questions, always feel free to email me. You can go to the website alignwealth.com, ALIGNE wealth.com. You can submit a inquiry or a topic that you'd like to have discussed on this podcast there through the Contact Us page, or you can email me directly at Ivan, I-V-A-N, at alignwealthllc.com. That's ALIGNE wealthllc.com. Talk to you next time.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanillan.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.